You've likely felt the frustration, watching the Euro USD oscillate inside a claustrophobic 30-pip range for weeks on end, waiting for a breakout. The global economy is shifting, but the Federal Reserve has locked into a neutral terminal rate equilibrium. They are holding steady, focused squarely on maintaining a soft landing. For major G10 currency pairs, this holding pattern significantly reduces the viability of momentum-based strategies. When price action remains this tight, the historical edges used by retail traders begin to thin out. As the core pairs stagnate, capital is increasingly migrating toward the periphery. Many intermediate traders are finding that emerging markets offer the movement and interest rate spreads that the major pairs currently lack. This migration is driving a return to yield-seeking flows, specifically targeting emerging market central banks that are actively maintaining hawkish, high interest rates. The U.S. policy rate sits at 3.5%, while Mexico defends 8.5%. Shorting USD MXN captures this 500 basis point gap. Over 30 days, that daily swap payout accumulates into a steadily rising equity curve. This is a highly calculated structural extraction of central bank policy divergence, built on deep liquidity. But high yield means nothing without structural stability. For the Mexican peso, that stability comes from the maturity of the nearshoring boom. Manufacturing supply chains have physically relocated to North America. Corporations are building multi-billion-dollar electric vehicle plants inside Mexican hubs like Monterrey. To pay local contractors and fund these massive operations, global corporations cannot use U.S. dollars. They are forced to continuously convert those dollars into pesos. That constant high-volume corporate demand injects a relentless flow of foreign direct investment into the local economy, establishing a rigid support level for the currency. Because of this persistent industrial demand, the peso stands exceptionally resilient against traditional U.S. dollar rallies, drastically reducing the risk of a sudden collapse in your carry trade. A similar structural pivot is supporting the South African rand. For decades, the rand moved in lockstep with the price of gold. Today, relying on that old correlation will lead you astray. The global rush for electric vehicles and renewable energy grids has shifted the industrial logic behind the rand. South Africa holds a distinct geographic advantage in this new supply chain. The country controls over 70. When you see a spike in Chinese or European manufacturing demand for these specific materials, there is a delayed, proportional upward surge in the ZAR's value 2 to 3 weeks later. The rand has shed its status as a safe haven defense. It is now a high-beta, industrial-strength bet on the global green energy transition. Capturing these massive yields requires navigating hostile conditions. Exotic currency pairs carry exceptionally wide spreads, and the slippage can quickly erase your margins if you execute poorly. Never enter a USD-ZAR trade during the off-peak Asian session. Liquidity drops so severely during these hours that the spread can double or triple before your order even fills. This visualization shows the stark difference in daily volatility. On the left is the tiny, compressed average true range, or ATR, of the UR-USD. On the right is the massive, volatile ATR range of the USD-ZAR. You have to actively adjust your position sizing to match this reality. If you apply a standard 50-pip stop loss to the South African rand, that boundary gets instantly swallowed by normal intraday market noise. It's mathematically useless. To survive, you must first multiply the pair's ATR to establish a wide, durable stop loss. Then, drastically shrink your lot size so that even with this wider safety net, your maximum risk remains exactly 1% of your total account. Utilizing a wide ATR-based stop alongside a micro lot size provides a mathematical framework for surviving EM volatility. This approach allows the trade to withstand daily noise while collecting the yield that defines the carry trade. The 2026 Forex market has shown that focusing solely on G10 pairs can lead to long periods of stagnation. Diversifying into emerging market currencies offers a powerful way to find alpha when the traditional core remains quiet. Success in these pairs demands a strict dual focus. You actively exploit macroeconomic yield gaps, while simultaneously protecting your capital with uncompromising volatility-adjusted risk management. It's time to build your strategy. Download our 2026 EM Volatility Guide and use the FXNX position sizing calculator to correctly calibrate and execute your first USD MXN or USD ZAR trade.